Good morning, everyone. Today's webinar, Creative Approaches to Enhancing Liquidity, will be starting in just a minute or two. Thank you for joining us. Good morning. I think we'll begin. My name is Jeff Pomerance, and I'm joined by Tsarovsky, and we're very happy to have you join us for today's first part of a webinar series entitled Creative Approaches to Enhancing Liquidity. Today we're going to focus on tax incentives and credits. Our biographies are listed, but briefly, I had the transactional practice of SulmeyerKupetz, which is one of the premier insolvency, financial restructuring, corporate litigation shops. We have over 70 years of experience. I, in particular, focus on the life cycle of a business from startup to early stage to liquidity events. And this area in particular taps into my legal background, but also my prior experience. I was formerly the Chief Operating Officer and General Counsel of Digital Media Campus, which was a venture-backed incubator. So I have certainly a level of appreciation for how hard it is to operate businesses as well as to get involved in the legal and other areas. I'm very fortunate to be joined today by Tsarovsky. Alan is a managing director of the Tax Advisory Group, a boutique tax credits and incentives consulting firm representing numerous businesses ranging from early stage through publicly traded Fortune 500 companies. Alan's guided and assisted aerospace, healthcare, manufacturing, software, technology. He's really hit all the industries in their pursuit of monetizing tax incentives available to them for the entirety of his 2 decades. Wow. 2 decades of law practice. He looks much younger in person. Previously, Alan served as in-house counsel and director of audit defense at the tax credit company. Okay, jumping right along. I want to begin by giving you an overview of this webinar series and what we're trying to do in terms of rethinking cash flow and liquidity. I've seen a number of participants today, and really it is rethinking. I'm very humbled by the people that have joined our program and recognize that it's pretty commonplace. You don't need to read the Wall Street Journal to see that GE is looking to maybe move one of its divisions for cash flow purposes. Cash is extremely important, and any business, whether it's sole proprietorship or Fortune 500, doesn't need to know that cash is important. With that being said, I think there's a historical perspective that we've seen in up and down markets that I'd like to kind of explore with you in the concept of rethinking cash flows. You know, in the internet bubble days, way back when, I worked with companies cash was so prevalent that they didn't think they needed cash. And instead, what they ended up doing was doing revenue shares between their interface and the other participants or partner. That was the goal, to gobble up relationships. And in fact, I know in 2000, I think it was Ether Systems, another one, really tried to go public, do an IPO on a non-cash flow positive company. So there was a time at which there was so much cash readily available that people didn't really focus on it. And we saw from that historical perspective, those companies didn't make it. So too, during that time, people would go out and companies would go out and raise money, and they just wanted as much as they could, as fast as they could. And one of the things that I've seen over the years is really that not all cash tastes the same. I've been involved in companies where certainly investors brought so much more to bear, so much more value than simply their cash infusion. So we see that, cash certainly is important. It's important how you manage it. We also saw that lessons from the 2008 market downturn, even for those that managed it well. And when I'm talking about companies that I worked with, that had lines of credit, that hadn't used them, that had availability, and when the market downturn hit, the line dried up, the lender closed the line, and they were strapped for cash. So clearly, from the historical perspective, if as the Bard would say, those that forget history are doomed to repeat it. Recognizing the historical perspective of what happened in the good times and the down times suggests that managing cash is extremely important, and it's not just sales or not just cutting expenses. We're seeing that even more today. Lessons from the COVID-19 experience, all of us have seen that service providers and those that weren't sitting on significant cash resources have been severely challenged over the past year. Many of them either have or certainly may be filing for bankruptcy or other insolvency because they just didn't have enough cash to and certainly no one could have, in any fashion, projected what would have happened in 2020. But nonetheless, we see that it's extremely complicated, and managing cash is really as much an art as it is simply, following the standard approaches that lawyers, accountants, financial advisors have suggested. It's interesting, today's lending market and the investing market, when you look at it, there's a ton of cash on the sidelines. The interest rates are at historic lows. Yet many of the clients that I speak with are having trouble accessing those loans because candidly, in a lot of the lending that I see in businesses, the hard money lending, it's based on cash flows. It's based on collateral base, all of which has been severely challenged. So managing cash really is a very difficult proposition, even for the most sophisticated. One quick story, when I was at Digital Media Campus, we had a number of subsidiaries, and we had these brilliant minds come down. One of our investors was a fund and populated our subsidiary boards with newly minted MBAs that talked about the matrices of development for startup companies. And for those of us, and I had more hair in those days, we pulled our hair out because for the companies that we were dealing with, the real measure was cash flows and where are they on their cash flows. So with that, I want to now talk about cash flow or cash as a measure of performance. If I told you that you're a startup company and you have $100 million in cash, you might think to yourself, wow, that's fantastic. And certainly that is fantastic. What I told you that you also had a $200 million loan that was repayable in 3 years or 2 years. While the cash is certainly a wonderful thing to have, I'm never saying don't have cash. But what I'm suggesting is cash alone is not a measure of success, nor a measure of performance. And what I want to suggest, and what we're going to explore today and in these webinars the series, is cash is really a measure of sustainability. When you have cash, you have runway. One of the things that we saw in the old days, prior to 2008, actually prior in the early 2000s, was that companies that got funded by certain funds knew that they could always go back and get more. The idea was they'll always help us build our runway. That changed significantly. And certainly in today's environment, my understanding, my dealing with various financial providers is that there's no such thing as a built-in runway. It's measured on your ability to perform. To be able to perform, you have to be able to be sustained through good and bad times. And so what I want to suggest to you as we move forward is that the concept of cash is really a measure of sustainability. If you have it and you're doing well, great, maybe it allows you to expand. If you're not doing well, that cash may allow you to continue to build your company so that you can achieve positive performance, cash flow positive, and build from there. So the goal of the webinar and this webinar series is really to revisit the notion of sources and uses of cash. Typically when we have these type of approaches, we have the sources is investment, loans, sales, maybe extraordinary sales, and that's our sources. And our uses that financial advisors really focus on is, what are you doing with that and how can you do that intelligently? And certainly both parts are important. But there's something missing, and that's why I'm actually very excited to have Alan join me today, because the line item on that sources that perhaps companies aren't looking at, and that's tax credits and incentives as a source of cash. Now, I mentioned in the outline, I talk about pockets versus lining. Typically, when you have a bill and you need to pay for it with cash, you reach into your pocket. Now, whatever's in your pocket will hopefully, if you're fortunate, will satisfy that cash. But what if it doesn't? Our goal today, and I place this upon Alan, who's going to really be leading this, is that I'm suggesting that there's cash in the lining that you're not looking at. And with that cash in the lining, is you're not just looking in your pockets. You have the ability to take care of the liabilities and obligations that you may not have if you just simply reach in your pocket. So again, this is the first of what I hope is 4 webinars. We're going to be exploring hopefully in the next couple of months, operational efficiencies, exploring financial efficiencies, and exploring creative financing options, and those are to come. I want to turn your attention now to our outline and briefly run through it just so you have a framework of where we're going. Today we're going to focus, as I said, on utilizing tax credits and incentives to improve liquidity. We're going to talk about what you're not going to hear, so that we can make sure that you come away with this knowing really, what we're trying to present. And I think it's important to have a brief discussion on why tax credits and incentives. Why are we starting with that? Alan then is going to jump into and really break down understanding tax incentives and credits, the key terms, the credit aspects, best practices, and lastly, we'll conclude with closing remarks. So I want to touch on today's focus on slide 6 of utilizing tax credits to improve liquidity. First of all, let's talk about what you're not going to do. There are no simple solutions. This is not simply fill out a form and fill out the following 8 items and you're good to go. As you'll see, it takes thought, it takes work, and that work is really designed to merit significant benefits. You're not going to hear any guarantees of outcomes. There are always for all of us, and most all of us have to deal with a government entity at some point. There are always risks, whether it be that the plan you put in place may change because of political and governmental laws that are government passing new laws and various approaches. There's a number of reasons why we can't guarantee outcomes, and it's not applicable to today's webinar. The third thing I want to talk about, tying that along, is specific deal structuring recommendations. We have, over the years, and Alan can really address this, there are specific recommendations how to, developing from practices to best practices, which Alan will discuss. But the notion here is it's very fact sensitive. And so what I want to suggest is really it requires that we get involved and help in custom fitting it to your situation. The last thing, very briefly, is tail wagging the dog. There are a number of reasons to do things for tax credits and incentives, and there may be overriding reasons to suggest otherwise. I think that a nuanced approach, using this among the many ideas that you employ in how to best manage your company, is really where this needs to be. So let's talk now very briefly about why focus on tax credits and incentives. First off, this is no secret, tax liability is universal. It's agnostic to business cycle. It's agnostic to the company's site, where they are in their life cycle, industry, performance, companies that perform well, perform less, they still have a tax liability component generally applicable to them. Secondly, it's a significant and primary cost of doing business. Every business not only has to deal with it, it can be, as Alan will highlight, it can be significant. But making it even more complicated, there are multiple layers of approach because you have federal, state, and local issues that can achieve this. The third thing is what I would call the direct approach. I had a high school basketball coach that imparted really 3 lessons to me that I thought made going after tax incentives and credits first on our list. First off, in my day when I played basketball 1,000 years ago, we were taught, we didn't have, I don't know if anyone has the skills of Kyrie Irving, but the misdirection plays that are prevalent today, in our day it was first step, go to the hoop. You want to get to the basket, go directly towards it. So given the importance, given the universal application of tax, it made sense to start with it. The second thing was, on our high school team, we had enough guys that were very, very tall. One of them was 6'10". And so our coach said, look, if you're going to go to the basket, go right at them. This is where you challenge yourself because you've got to get there. And if you don't, the reality, it may get blocked anyways, but you have a better chance of going and getting a basket or getting a ball. The third thing, and this helps me transition to Alan, is our coach always identified if there's someone that's talented on your team and they're open, you hit them, you find them. And I feel very fortunate to have Alan agree to join and participate in really exploring this, giving this kind of a face, coming up with some practical suggestions. We're going to be talking about the mechanics of tax credits and incentives, the sources, uses, and the taking action. And with that, Alan, please jump in and let's go.
Jeff, first of all, thank you so much for everybody taking the time out to spend some time with myself and with Jeff. I've known Jeff for quite a few years now as a colleague and as a friend, and I very much appreciated the invitation. And I look in very many ways. I look to Jeff as a source of a lot of wisdom in this space, in the general tax space and deal structuring space. I think that the shift here, right, which is I think is an important one in terms of a shift of focus, right? Generally speaking, when people are doing tax strategy, right, oftentimes they're focusing in on deal structuring, how to get into a deal in the most tax efficient way how to, you know, and not how to get in and how to get out, the liquidity event. Those are sort of the areas where, tax counsel generally gets involved. And there's a number of very important strategies. We're not discussing those today. What we're discussing today is the actual management and operation of a business, of a portfolio company if you're an investor, a PE fund, or if you're an owner and operator of your own business, if you're a CFO. And what are the, as just Jeff beautifully outlined, what are the opportunities to more efficiently manage the liabilities that you face? And especially some of the points I know that Jeff mentioned, but just to sort of reiterate from an introductory standpoint, number one, every business sitting at the apex of multiple jurisdictions, right? Federal, state, local, county, taxes, there are multiple taxes that are levied on any individual business, punishing ones oftentimes, particularly in states like California. And what I have found in my own work is that everywhere where there is a branch of government that is levying a tax, there is oftentimes a corresponding opportunity to work with government to reduce that tax. And that's what credits and incentives are, right? Fundamentally, credits and incentives are available to an owner-operator to increase their cash flow because they are doing some kind of qualifying activity that is consistent with some policy that local, federal, state, county, city government is interested in investing in. So with that in mind, we're just going to move forward. I think it's, let's get some concepts and terms laid out. Let's have a working understanding, a working definition. I think any of the key terms that we're going to go over here in just the next few minutes, any of these key terms really could be a much broader discussion. But for our purposes, we want to have a working definition that allows us to communicate with each other, right? In the event that there's additional communication beyond this presentation, of course, Jeff and I are always going to be available. But we want to have a working definition. We want to have a working definition for this conversation, and not particularly go too deep on the technicals, but just to make sure that we have a common language that we're all able to utilize for this conversation. Hopefully, Jeff, you'll just jump in if there's anything that I'm sort of going too quickly on, or I don't want to gloss over any important concepts. So really quickly, let's just sort of run through some of these key terms. So tax avoidance, right? So we want to make sure that tax avoidance is not confused with tax evasion, right? So very, very generally speaking, tax avoidance is essentially just minimizing tax liabilities that a company is going to face. And we're going to sort of briefly touch on the different types of taxes that companies have to pay, that the business community has to deal with. It's really using legal methods to minimize the amount of tax that's owed, whether it's income or transactional or payroll or otherwise, that's owed by an individual or a business. And it's usually accomplished by claiming as many legitimate deductions and credits as are allowable. Now, what's interesting, as we'll sort of uncover, is, and I don't want to jump too much ahead, but in the world of corporate franchise taxes and income taxes, et cetera, there are more opportunities than just the list of deductions and credits that one might find, in a software that just lists them out. We'll sort of go through some of those areas and those opportunities. But generally speaking, what we're in the business of is trying to find legitimate opportunities to reduce our tax liabilities, the various ones that we face. Tax incentives. Okay, so tax incentives are essentially methods of reducing taxes for businesses or individuals in exchange for specific desirable actions or investments on their part. This is what I just mentioned just a moment ago. The purpose is to encourage the taxpayer, whether it's a business or an individual, to engage in the type of behavior that the various levels of government have deemed socially responsible, beneficial economically to the community. They're something something that within that jurisdiction is needed, right? And needs as determined by legislature and executives who are running that jurisdiction. Tax credits, right? So tax credits are actually amounts of money that taxpayers can subtract directly from the taxes that are owed to the various branches of government that we're dealing with. Unlike deductions, which are mostly specific to taxable income and reducing the amount of taxable income that the taxpayer is responsible for. Tax credits actually go dollar for dollar. They reduce the actual amount that the taxpayer owes. Tax credits usually are offered by the different branches of government, federal, state, local government, to promote the specific behavior, right? So really what's happening from a policy standpoint is that branch of government is attempting to influence the behavior of successful businesses, right? So something that Jeff pointed out, which is just a really astute point, is cash goes to sustainability. Now, in the event, I guess, some of the deals that Jeff works on in terms of debt packages, right? So cash flow enables you to to service the larger amount of cash you have, the larger amount of debt you can service, the larger amount of activity you can engage in a business for an extended period of time. Now, what's happening is so the various branches of government, what they're trying to do with these tax incentives is they're trying to say, okay, if we can take these smart, these successful businesses that are sustainable on their own, if we can work with them, almost outsource some of the policy that we need executed by influencing their behavior through tax credits and handing some of the cash back, right? Reducing some of the cash that is owed, then things really start to happen. You get sort of you get revamped, revamped neighborhoods from a real estate perspective. You get investments in manufacturing. You get jobs brought back into an area which maybe is hungry for jobs. You get R&D. You get technology that's developed in local areas, and you get economic multipliers as a result of that. And the folks in government understand that. They understand there are certain job opportunities that if they can generate in their own community, they can create a tech space. If they can create jobs that are $75,000, $100,000 jobs and multiple ones of them, all sorts of interesting things happen in the local community, and they understand that, and they try to. And we'll talk about some of the things that attract government to these incentives. Companies use tax credits, going back to our definition, right? Our working definition, use tax credits to offset the obligations that we talked about and generate savings, build a stockpile of cash, sort of reach some of the meta goals that Jeff outlined at the beginning of the presentation. The value of a tax credit oftentimes depends on the nature of the credit, right? So there are going to be credits in different locations. There's going to be different classifications of types of employees that jurisdictions want. There's going to be different that folks want to incentivize. All that sort of factors into how a credit is valued. Let's just sort of broadly talk a little bit about categories of tax incentives. Now, by the way, as a quick side note, I love doing a conversation like this. I wish we could sort of be in the same room, in the same space, particularly with Jeff, because there's obviously a different kind of energy when everybody's together. But what's nice for me is I can kind of take a step back and look at the big picture in a conversation like this, and I can sort of map out for everybody where the different, sort of what's the total landscape and where different opportunities lie will depend on where we sit within that landscape. So from a legal standpoint, when we're talking about categories of tax incentives, your baseline tax incentives, call them low-hanging fruit, is, and actually I'm going to say low and mid-hanging fruit, is statutory ones. In the case of excuse me, I just got a message that I need to speak up. Is this hopefully this is a little bit better, and if anyone's still having a problem, feel free to message the panelist, and I'll adjust my volume accordingly. By the way, that may be the first time I'm sitting in my own house that I've ever been asked to speak up loudly. I think if my wife was sitting here, she would take issue with that with that request. But hopefully this is a little bit better. So from a statutory standpoint, right? So those are the credits and deductions, sort of on an even lower level, and credits that are that are identifiable through just real serious legal research, right? Our company happens to have a team of folks that we really do homework on what the statutes say in a specific jurisdiction. what elements are laid out in the law that give you, as a taxpayer who's engaging in a certain kind of behavior, they're generally referred to in sort of our community of professionals as right credits. In other words, you are owed these credits. You may not pursue them, but you are owed them. And in general, laws have to be passed by legislatures in order to expand or create these new tax credit programs. That is what we call statutory. Now, I mentioned that there's a difference between low-hanging fruit and mid-hanging fruit, right? And the difference is as anything in the law, right? When you have a statute, right? Or just really quickly, by way of background, what attracted me to tax law as a lawyer when I was in law school, I had a wonderful, wonderful tax law professor who mentioned that, who presented to me tax law in the following context, which I just loved, and I'm fairly confident Jeff is actually going to relate to what I'm saying right now, is that tax law is the apex of policy, right? Where you have your real policy and real action coming together. You have a goal, right? Tax law is like, I have a goal. I need to either raise revenue or I need to raise investment in a community, and I'm going to pass a rule or a law that will enable me to do that, right? So laws are passed or expanded to create new tax credit programs. That happens in legislatures. It happens on an annual basis, depending on the economic circumstances, budgets, etc. There's all kinds of sort of reasons why credits are passed, why credits are withdrawn, why credits are replaced. Negotiated discretionary programs. That has a substantial nuance to it, a substantial distinction. Here, different jurisdictions will set up economic development programs. They'll set up branches of government that are dedicated to achieving some of those economic goals that we talked about, right? And negotiations are within these branches of government, they'll have representatives that are negotiating with the business community based on specific projects, project by project basis, where the taxpayer is making certain kinds of commitments to that jurisdiction, that local government official. And to qualify for this type of benefit, a company has to demonstrate that it's not going to proceed with the project in that geography if they don't receive the tax incentive offered. This has obviously become substantially more I should say prominent or in the news, has received a substantial and significant uptick in attention as a result of companies like Amazon, right? As a result of companies that are literally really trying to pit jurisdictions against one another. Now, what's amazing is, and by the way, it's Amazon, it's Tesla moving into Nevada. More often than not, and it really baffles my mind why the California has not sort of has not gotten ahead of this. Very often, more often than not, it's companies leaving California looking for greener pastures financially. And in this area, that's what's happening. Is companies are sort of conducting these negotiations. They're pitting jurisdictions against one another. It's oftentimes states, sometimes it's counties, sometimes it's cities, and oftentimes we would call it the BATNA in law school, the best alternative to a negotiated agreement. And negotiations is sort of like, what's your alternative? So, a company will come in and say, I'm going to do X, Y, Z in order to pick up some of the benefits that are available to me. Now, what's happening in this space, right, is quite a few things. First of all, we generally assume that this is available to Fortune 500 companies and companies that can make the biggest splash in the Wall Street Journal or otherwise, right? And that's true. That is true. That is true. That the different economic development agencies, for them, they want the biggest prize possible for obvious reasons. It's like you're getting the most bang for your buck, right? But it's not true that companies that have sort of, we'll call them middle market businesses or even startup businesses, et cetera. It's not true that we shouldn't be actively and aggressively trying to talk with different parts of the country to see, where does my business fit in with your economic plan, right? Where do I fit in? Because if my interests are aligned as a business owner, if I have a particular type of company that your jurisdiction wants, we should be teaming up together. It doesn't make sense that I'm spending, I'm spending more money on taxes being somewhere else, particularly in the flex work environment that we're all facing now in a post-COVID era. So that's sort of a really couple of quick comments there. Qualified activities criteria. So any incentive that we're going to discuss, and this is sort of why I mentioned that we can really do long presentations on any one of these items, and it, my team, we often do a lot of investigating to try to identify qualified activities within a business, right? So the government will set specific criteria for companies that are engaged in qualifying activities, right? And they will limit, and oftentimes they'll limit sort of the target of what they're trying to do to a certain industry, geographic area, investment size. It all just really depends. There's a list of particular, there's a wide list of activities that different jurisdictions will consider to be qualifying. And it's just based on the desired aim of local government in that area. Just by way of example, I happen to, thank God we've built a nice practice in the aerospace industry. We have a couple of companies we represent that have been really long-standing. We have long-standing relationships with them, and we've gone through all kinds of wonderful experiences, some of which I'll detail, a little bit later on. But it happens to be that Oklahoma, right, really wants to continue to build out its aerospace industry. Prior to me having the sort of the blessing and the opportunity to work with some of the companies that I work with, I didn't know. To me, I thought aerospace was Florida, it was California, and I didn't sort of know that there's other parts of the country that are actively trying to generate that industry, and that's what happens. And so that's an example that the state has gone through and really put together some very nice packages for aerospace companies, both on the statutory and the negotiated side. The last piece of this is retroactive versus future planning. Okay, so. What's interesting here is, a lot of times, and what we're going to try to do in this conversation today is hopefully stimulate folks to start thinking about this in a forward-thinking manner, because oftentimes what happens, from what I've seen, is, and maybe folks here have a different experience, but the accounting firms that represent the companies that would want to pursue these incentives. All the conversations are taking place at the end of the tax year. Hey, okay, now I know my liabilities, now I know my income, now I know what I've done, what can you get me right now? And it really ties the hands of the service provider, right? And it's always a retroactive conversation. And when it's a retroactive conversation, first of all, you have lost the entire opportunity for any negotiated or discretionary programs that are available to you. Second of all, even in the statutory world where we talked about, there's the low hanging fruit, which are really sort of easy to grab. And then there's that middle level where you've got to identify whether the activities that the company is engaged in, do they fit within that framework of what's called qualified activities? And if they do, is there a notice component? A lot of times there will be a notice component to the government that has to take place early on. So we got retroactive versus future planning. That's the general sort of broad conversation about tax incentives. I'm going to go through the next couple bullet points a little bit quicker because I don't want to lose too much time. Types of taxes to offset. If you ask any accountant, they'll give you a full list of taxes that any business has to deal with, but it'll be everywhere from income franchise taxes, depending on the state, federal government, payroll taxes. Payroll taxes are an important piece. When Jeff talked about where's that money in the lining, any opportunity to offset payroll taxes, that is fundamentally what the type of issue that Jeff is discussing, because that's a transactional tax that is the cost of doing business. Property taxes and payroll taxes, utility telecom taxes, those just have to do with just operating your business. There's no sensitivity to whether business is up or down unless there have been programs that have built in. For instance, we have in the CARES Act that just passed this past year as a result of COVID. You had the employment retention tax credit, the ERTC, which was available for originally for folks that didn't take the PPP. Then they made an additional they updated it to say even if you took the PPP and you're a particular size of a business, you could grab that. That was a great benefit for we worked with some companies in that space. That was a really tremendous benefit for businesses that were trying to hold on to their employees. Really, that was the whole thing. We wanted to hold on to our core unit, our core team. We don't want to get rid of everybody. And there was a reward for that. There was that, and that reward came in the form of offsetting payroll taxes. That is a gold mine whenever there's an opportunity to grab an offset to a payroll tax, because you're paying it whether you're making money or not. That's very different than income taxes or franchise taxes. that may have some a more significant relationship to how well the business is doing. Claiming tax credits. So in terms of claiming tax credits, so companies generally can claim tax credits on their income tax returns. That's the income tax return is sort of where everything happens. We talked that we're not going to discuss too much on forms, but that's sort of where all of this takes place. Tax credit programs often require, documenting the fulfillment of requirements. So businesses do need to plan for what we would call credit reporting requirements and calculations in advance and keeping those records to prove compliance. This is an area where everything falls apart, right? Really, everything falls apart because one of the tension points, and this is there's a few different things to walk away from this presentation from, but one of the tension points of why, in my mind, this is something that you want to have a team of outside pros that are helping you on, is it's not just record keeping, like, okay, I'm keeping a list of dollars that I spent, but it's record keeping for purposes of proving that you have fulfilled the requirements of either the statutory program or the negotiated program. The negotiated program, by the way, is really where everything falls apart. And this, by the way, so I'll give a little bit of a background. I happened to work with this was a number of years ago, actually, before we started our company. I was working, in sort of a previous firm, and there was a pretty sizable chip manufacturing company that had we'll call it their nucleus was in the state of Tennessee, I believe. And they had negotiated before we came on board. They had negotiated a tremendous package. In terms of sort of, they made some commitments. We're going to hire X amount of people. We're going to, commit X amount of CapEx. And there was a benefit that was agreed to. There was a contract that was signed. There were compliance requirements. Well, guess what? So there were folks that were designated as the ones who were responsible for negotiating the deal. And then the operations people never really took the time to sort of understand the contract that was signed with in that instance. It wasn't state government. It was a particular county. I believe it was Franklin County in Tennessee. But they had signed a specific deal. There was no conversation that took place between the folks that negotiated it, which was the real estate group, and the folks that were in the operations side, right? And so when it came time for compliance, the records were not really tracked. There was not really a sort of a systematic presentation of here's what we committed to, here's what we did. And even though on paper, everybody was high-fiving each other, oh, we've got a $5 million package, everybody's always so excited, right? We come in 2 years later and we're like, well, where's the money? And they're like, well, we lost track of what we were supposed to submit. What we did submit didn't come in at the right amounts, etc. And there wasn't even much of a reconciliation. So what really falls apart a lot of times on the claiming of the tax credits, particularly in the world of negotiated incentives, is just that communication and compliance element, that active collaboration where an outside firm can come in and say, all right, listen, this is what you signed. So first of all, the lawyers need to explain what everybody signed. That's number one. Like, where are the requirements, in terms of not just that you're engaging in these activities, but how are you substantiating and proving them? Who are you supposed to report them to? How do you make sure that the money came in that was supposed to come in? Do you have an accounts receivable, set up on your chart of accounts? So those are some of the issues and things that come up. Audit risks are always there. There's always issues of clawback. There's always issues of recapture. A lot of times you want to make sure that you're not running into a problem where, again, if you have not properly documented, there could be interest, there could be penalties that ensue. So I think those are the audit risks are always there. And again, another reason why you want to just make sure that you have competent professionals that are with you during that process. Okay. I'm going to just run through a couple of more concepts here. Tax credits can come in refundable forms. Very, very quickly. Refundable tax credit is when, irrespective of how much you owe, you are going to get that dollar amount, right? So if it is a $10,000 refundable credit and you only have a $5,000 tax liability, you would actually get a $5,000 check as a result of a refundable tax credit. Now, oftentimes, refundable tax credits can actually be sold. And there are brokers that work on sort of, depending on the type of tax credit it is, most notably film tax credits are oftentimes generated by, they're generated in jurisdictions where you can't get an actual, they are refundable, but you can't get a check for them. So you have, sort of a coupon on a tax liability that's just sitting there, and you are allowed to sell it and transfer it to other folks. Again, could be an entire presentation on that. Non-refundable tax credits usually come with a carry forward option. So a non-refundable tax credit is, okay, I've generated $100,000 of R&D tax credits. I don't have the income tax credits. I don't have the income tax liability to offset it. So there'll be a carry forward option that says I can hold on to these as an asset going forward as the business grows and income comes in. Okay, I'm a big fan of Quentin Tarantino movies. I don't know, ever since I was a kid, I think I fell in love with Pulp Fiction. And so I'll say why I bring that up is because I like to show sort of the end of the presentation and work our way, sort of go to the end, then come back to the beginning and get back to the end, right? And that's sort of the Tarantino style of filmmaking and storytelling, which I think is very compelling. It gives everybody a sense of exactly what's happening and where we're going. So when we're talking about operational excellence, which is what we are trying to achieve as a group here, right? Everybody who's in this conversation right now wants to not only learn about these programs, wants to go after them and get them, and wants to do it in a way that, we'll call it operational excellence, right? Time is of the essence. You don't want to step into a program and not even sort of get the full benefit from it on day one and have somebody come back 3 years later and say, wait a minute, you missed all these dollars. We want to get it from the very beginning, right? And so the steps here is really, you have to, nobody knows your business better than you as an owner, operator, investor, whether you're angel or late stage. You have to understand your business. There's going to be documents that you want to make sure that you really sort of are keeping track of as part of this process. You want to identify all the available opportunities that are there, right? We want to really have a nice research process in place where we're grabbing and making sure that we're keeping up to date with legislative changes. We're tracking, by the way, who else is getting who's getting packages in the jurisdiction that I'm operating in that's a competitor of mine. Right? If somebody who's competing with me picked up $1 million for expanding a facility, why am I not getting that money? And what do I need to do, right? Documenting qualified activities. Again, we just mentioned, are my folks who are either negotiating deals or identifying opportunities, are they communicating with the folks that are actually, on my team that are designated with the responsibility of keeping track of that documentation that's going to make sure that we use later on? Preparing forms, just making sure that we understand the details. The devil is in the details on all the various forms that are available. And then, of course, compliance, making sure you're managing your calendaring, your document management, your audit requirements are up to date, et cetera. Okay. I want to take a quick moment here to distinguish between NOLs versus tax credits. Okay, so tax credits are aimed really to motivate growth, right? As opposed to NOLs that are motivated to manage losses in businesses, right? So if you have an NOL, you can sort of, theoretically, you can carry it forward. Jeff would know off the top of his head better than I would. I believe it's maybe, 10, 20 years, maybe I think it's up to 20 years you can carry it forward. And a net operating loss generally exists if a company's deductions sort of have exceeded its taxable income. You've spent more money than what you have made. NOLs benefit companies by reducing taxable income in future years, and it functions as a tax deduction. What's incredible is really something incredible that happened under the Trump administration is when the TSGA was passed, right? There was a limitation that was put. So previously, you have your NOLs, you use them as much as you want. You generally don't have, you have, particularly, by the way, this affected PE firms, right? So in the PE space, every shop is going in, acquiring a business, loading it up with debt. The debt service generates the NOL. You have no taxable income for quite some time. And that kind of generated a certain passivity in terms of tax planning. Because even the credits that are available to you actually have a shelf life of 20 years, you're not necessarily thinking about gathering those assets. You're thinking, look, I'm managing, I have no taxable income because I have this very large NOL. Couple debt service with downturns in economies, et cetera. People were resting on these NOLs for quite some time. Comes the TSGA under the Trump administration, what they needed to do, right? Again, we're always thinking about things. I don't mean to get too academic here, but we're thinking about things both from the perspective of the government and the perspective of the taxpayer. So in order to pay for all of those benefits that the TSGA allowed for, they needed to generate some income. So what do? They put a limitation of 80% of 80% of the NOL, or excuse me, 80% of taxable income that applied to NOLs could be offset by NOLs. So suddenly that spread created an income tax liability. Forget all the other categories we're talking about. At the federal level, there were income tax liabilities that were suddenly being incurred because you couldn't use all the NOL that you were generating in a particular year. That was suspended. As a result of the CARES Act and COVID, but it was temporarily suspended. Nobody should imagine that this suspension is going to be a long-term institution, right? Because if anything, government has spent money that it does not have. Every opportunity to generate revenue, they're going to do. So this limitation is going to, at some point, it's going to get reinstituted, and that's why tax planning is critical at the operational level. Okay. Credit aspects, identifying opportunities, right? So an ideal solution is going to really, like we talked about, it's going to depend on your industry, workforce attributes. What kind of folks are you employing? Are you employing engineers, or are you employing, waiters and waitresses? Look. Outside of COVID, COVID disrupted everything. But traditionally speaking, economic development was not focused on bringing restaurants into your community and was not necessarily focused on sustaining those restaurants. That was an added benefit. If there's a lot of restaurants in a nice shopping community, that's great. What government wanted in every jurisdiction was they wanted high-paying jobs. They wanted quality quality facilities that would create an economic multiplier effect that would eventually end up in having restaurants in your business because you've got working people and you've got people taking their families out, et cetera. But at the end of the day, workforce attributes, what kind of people are you employing at the high level? And we're talking in terms of maybe engineers or tech positions, et cetera. I hope this is not offensive. I'm not trying to use an offensive term, but sort of on the lower paying level jobs, on the minimum wage jobs, et cetera, the focus would end up being on by way of example, many people know about the work opportunity tax credit, which, extended a benefit, not just toward, of course, our veterans, but also toward people who maybe are coming out of the prison system who are being reformed. That's a social aim, and that created an opportunity. If there were positions that you could incorporate people returning back into the community, federal government wanted to incentivize that through the WOTC credits. So workforce attributes are important. Locations, obviously important. Strategic goals, where are you located and situated in relation to your business needs? Where are you locating yourself, and what does that jurisdiction want to accomplish in terms of the type of business that you're in? What I think is important, going back to a phrase that Jeff used at the very beginning, which is a critical phrase here, is not letting, and I'm going to make a little sort of twist to it, not letting the tax tail wave the economic dog. Nothing that we are talking about today. Nothing we're talking about it should be the primary reason why you do something. No one should misunderstand what I'm saying. You shouldn't go out and hire a person just because you're going to get a tax credit from it, because it's never going to work. The math is never going to work out. You should never open a facility in a place that is too far away from your customers if you're a last mile logistics business. It makes zero sense. You want to first figure out what's your apex of profitability? Where are you most profitable? And then using a term from what Jeff mentioned, then you sustain yourself by sort of going for these inefficiencies, going for reducing your tax liabilities in these areas. So that's what I'm talking about when I say locations and your strategic goals, right? As well as the resources and level of expertise that you have available to you. To try to find these opportunities. But the first question is always, what's available in the jurisdiction that your facilities are in, and what's available into where you are going, right? So you want to have that conversation with your CEO. You want to have that conversation with your strategic product team. Where is this business going versus where it is right now? Jurisdictional incentives are going to be available at the federal, state, county, city level. Legal changes are going to occur on an annual basis. They require a constant review of the law, and I think just like anything else. Okay, we've already sort of gone through, I think at some point we're going to be passing out this package. Just really quickly, there are examples of discretionary incentives and statutory incentives. Each of them are going to have specific detailed frameworks as to what they want from the constituents that are applying for them. And we just want to make sure that we're identifying opportunities that are material. The way you identify opportunities that are material is you do the math, right? So statutory incentives, it's easy to do. I shouldn't say it's easy. It's easier to do the math because you've done your research, you've identified how those credits are calculated, and you do the math and you see if it's a material opportunity in relation to your business. Discretionary incentives is a little bit more difficult. There you have to actually do some real homework and to see. So
Alan, let me jump in for just a moment. I know we're coming up against it. I asked Alan for the impossible. As you can see from the presentation that Alan's done and the slides, this is really complicated stuff. There's a lot to it. So I want to just kind of wrap up a little bit. But first, Alan, maybe in just a moment or two, give our participants a kind of a sense of what they should be thinking about as they move forward with this, so that they can take this material, which by the way will be provided to you on the conclusion of the webinar, and use that to kind of generate an opportunity to enhance liquidity.
You want to have a sort of a summary takeaway?
Correct. Correct.
Okay, I think that's fair. I think and I apologize. Just Jeff knows this. I love what I do, right? And I really love this space, and I love connecting, and I geek out over all this information. And I certainly would love to have additional conversations and follow-ups and go into more detail to the extent that I haven't bored everybody yet. But I think there's sort of two takeaways, right? So takeaway one is, and I'm going to put up one more slide, if that's okay, Jeff?
Of course.
Yeah.
Of course.
So I'm just going to go ahead and put up, hold on one second, I'm sorry. Let's just, okay. Okay, everybody's sorry about that, hold on. Okay. I'm apologizing, sorry. Okay, and, okay. So takeaway one. You have to sort of, knowing that this stuff is out there, right? And it's available to me and being motivated to go after it. You have to realize that just like with any type of project management, there's going to be a decent approach, there's going to be a better strategy, and there's going to be best practices, right? And that's ultimately going to be determined by the amount of credits and incentives that are available to you, that you've taken advantage of, and that you've quantified, right? And it's going to take time. It's going to take effort to contextualize your results with your competitors' results and with other people in your industry and other industries. And it's going to take time to sort of implement processes where people are communicating with each other and someone is overseeing that. But the difference between a decent approach is, okay, I got what was available to me, and I didn't put too much, I put a little bit of time in, that's the decent approach. Better strategy is that. It looks like I'm pretty diversified in the amount of credits I'm getting. There's no consistent system that's in place, but when things are coming to my attention, I'm grabbing them and maybe reporting on the current tax credits I get, but not really tracking progress. And best practices are going to be that you have a diverse portfolio in place. You've got systems that are tracking it. You've got outside support in terms of expertise that's giving you updates on where the law is headed in the different jurisdictions that you're in. You're monitoring and having a conversation. Is the value of my credits going up? Just like any other cash account that I have, or any other receivable I have, or any, are my receivables going down, or are my payables going down? You want to just monitor the progress. And a lot of times this is an afterthought. So we want to shift our thinking away from this being an afterthought to something that we're excited about. That's takeaway one. Takeaway two is this area involves factual analysis. It involves a legal analysis. It involves a factual analysis, and it involves a financial analysis. And there's a lot going on in each of these areas. So I just very much encourage you as you sort of want to take a more proactive approach, just recognize that there's an interdisciplinary approach that's going to be required to bridge the gap from where a company is now in relation to their tax credit portfolio and incentive portfolio versus a best practice one.
Alan, that's great. And let me conclude with this. I feel like as a advisor, one of the real joys you have in transactional practice is when you can bring something to your clients to not only help them, they didn't even know about it, and you are able to really achieve amazing benefits. And this approach of this tax credits, tax incentives, it is really that cash in the lining of your coat that you didn't even know about. It's right there. The simplest example I can think of is you're putting solar, you have to put on an energy system in your home, and you have a choice between standard and solar, and you put on solar anyways. And by the way, by putting on solar, now you have a chance to reap additional benefits. So I'm excited because I feel like I've let the genie out of the bottle. People now know even more they knew before, but what Alan and his team can do. I would very much encourage everyone to reach out to Alan, to reach out to me. There are areas where certainly we can work together, but believe me, if you take the time to call Alan and follow up with him, I'm very confident you're going to find some cash that you didn't think existed, and you can put that into your sources and uses. I'll leave you with one other thing on this, and I'm dealing with a number of clients that you might say, okay, well, there's a few dollar amount here and there, maybe it's substantial, but even if it's not, it's important, because many times clients that I work with can turn their cash anywhere from 2 to 5 times, 6 times, depending upon what they do. So the ripple effect of this level of kind of effort towards finding cash that you already have can pay tremendous benefits. So again, thank you, Alan, for educating us. Please feel free to reach out to him. Our contact information is on the last slide. For those of you that are looking for CLE credit, we are a CLE provider. Certainly follow up with me and I'll make sure you get that. And again, thank you everyone for joining us, and have a great day.